Welcome to Talking Markets with Franklin Templeton. I'm your host, John Przygocki from the Franklin Templeton Global Marketing Organization. As a forward-thinking asset manager, Franklin Templeton leverages cutting-edge strategies and deep industry insights to unlock opportunities to help grow wealth. We're your trusted partner for what's ahead. I'm here today in the studio with Jeff Schulze for a monthly conversation focused on the United States economy. Jeff is the head of economic and market strategy at ClearBridge Investments. ClearBridge is an active equity manager offering a broad range of strategies across global markets. Jeff, welcome to the studio.
I'm excited to be here, John.
So Jeff, let me start by mentioning that in your most recently published insight, you titled it Resilience, which you use to describe consumers, corporations, and the economy during today's energy shock. With that backdrop, I'd like to begin today's conversation with your current view on the state of the economy in the United States, your team's foundation for determining the health of the economy is the ClearBridge Recession Risk Dashboard. Have we seen any movement with those 12 most important indicators that you follow with your May 31st analysis?
Well, I'm really excited to say that we did see some movement in the positive direction. Profit margins improved from yellow to green. And as a reminder to the listeners, it's a stoplight analogy where green is expansion, yellow is caution, and red is recession. And at the moment, out of those 12 indicators, we have 11 green, 0 yellow, and only 1 red signal, that signal being job sentiment. So the dashboard has some broad strength emanating right now, and that's a pretty encouraging development from an economic perspective.
So Jeff, the profit margin indicator just turned green. That's really interesting. Why was it yellow over the past year or so when the S&P 500 had clearly demonstrated very strong earnings growth and record profit margins?
The reason why the profit margin indicator is yellow, or was yellow, I should say, is because we don't look at S&P 500 margins, but rather NIPA, or economy-wide margins. And NIPA stands for National Income and Product Accounts, and it measures the profitability of U.S. corporations based on their income earned from current production rather than standard financial accounting. So it differs from corporate profit margins because NIPA strips out one-time accounting events, restructuring costs, and purely financial assets. Now, when you look at NIPA profit margins, it's actually 100 basis points below its high in late 2021. And last year, in the middle part of 2025, it was slipping, which drove that yellow caution signal, but it's improved materially over the past 6 months, which has triggered us to move it to a green signal. So, it's a green signal. It's one of the more important variables in the dashboard, and it continues to suggest that the economy is going to be pretty resilient this year.
In the opening there, I mentioned that in your insight from earlier this month, you entitled it Resilience, and you highlighted the consumer, corporations, etc. Why has the consumer held up so well in the face of higher energy prices? And do you think that this trend can actually continue?
Well, consumer resilience is being driven by a number of things. Now, first off, a lot of the consumption that we've seen in the US over the last couple of years has been from the high income consumer. It's created that K-shaped economy that we've talked a number of times about on the podcast here. But wealth effects are helping support consumption, not only because of the market rally, but the appreciation that you've seen in housing as well. So that's a key driver. The high-end consumer is healthy in spending. Now, there was some concern that the savings rate dropped to 2.6% in the most recent release, which is the lowest since June 2022. So to an extent, consumers are being squeezed by inflation, but I'm not really concerned about this drop because the savings rate tends to be lower when the ratio of net worth to disposable income is above trend, which is the case today. If you put that differently, consumers don't need to save as much when they have greater wealth. So A lower savings rate is driving some of this resilience. Also, you have the individual tax cuts from the One Big Beautiful Bill. It's going to be well over $100 billion through higher tax refunds and a reduction in taxes paid. And then lastly, and we've talked about this a couple of times over the last 3 months, you have less energy intensity for the consumer. Consumers spend about 4% of their wallets on energy goods and services, which is down from over 9% in the late 70s and early 1980s. Now, I do think the consumer will be less resilient in the back half of the year as those tax refunds get spent. But ultimately, even though I'm expecting a slight deceleration, I still think it's going to be over 1%, which is going to be a nice tailwind to economic activity.
So Jeff, you're essentially saying you do believe higher oil will eventually start to impact the consumer as we move to the back of the year. Why has the oil market been so, I guess you'd say, well behaved, considering the Strait of Hormuz has been effectively closed now for 3 months, is it? And is there a point where oil will actually move higher?
Yeah, if we were having this conversation 3 months ago and you said that the Strait of Hormuz would be closed today, I would tell you that the price of oil would be well over $100 a barrel. But the muted reaction is really a function of the oversupply that we had before the war. So inventories were well above traditional levels. And we've been drawing down those inventories over the last 3 months, but we're still 200 million barrels higher than what you saw in early 2025. And we're going to get to early 2025 levels in the beginning part of June, so about a month away from now. And we're going to get to the 2022 trough levels, which was the last time you saw a large energy disruption because of the invasion of the Ukraine, by early August. So I would imagine sometime in July, when we're between those two thresholds, oil prices are going to start to move up in a more material fashion because you do have a minimum level of inventories that are necessary to maintain the global system. Oil in the pipes, refineries, and the supply chains. And we will hit that when we get closer to Labor Day, when we'll probably see a more materially higher energy price. So I think they'll start to move higher in about a month. They could move dramatically higher if we don't have a resolution by the end of the summer.
So we know that a key driver or a key element of consumption is directly related to the labor market. We just got the May jobs report. What are your thoughts on the aftermath of that most recent release?
I mean, it was a really strong print. May jobs came in at 172,000, huge revisions to the prior 2 months. So now the 3-month average jumped 100,000, and now it's 188,000 total compared to where it was prior to this release. So it was a strong print, and it's confirmation that the labor market has stabilized and accelerated this year following 2025's malaise. Now, from the Fed's vantage point, though, it's a hawkish development because strong job creation and steady wage gains, along with that resilient U.S. consumer that we just talked about, is going to start to drive some labor-driven inflationary concerns. And the Fed's not going to be able to ignore that given what's happened to energy in the Middle East. So it's going to push yields higher, and we're seeing that in the aftermath. Rate hike expectations are going to move higher, and that's going to pressure the valuations in equities. But it's also going to be a positive when you're looking out on a longer-term basis because this labor resiliency is ultimately going to lift growth expectations. So it was a good print. The labor market is on a firm footing and accelerating. And one other thing that I saw from that print, which I thought was really encouraging, is that last year, labor market outside of healthcare created negative 271,000 jobs. So it was only healthcare last year driving the labor markets. So far this year, and we're only 5 months in, labor x healthcare has created positive 377,000 jobs. So you're seeing greater labor breadth, which ultimately is a good barometer of better economic momentum.
Fantastic. Greater breadth. How about artificial intelligence? I think I'd be pretty remiss here if I didn't mention the recent AI CapEx strength. How durable is the spending there? And has CapEx just become the AI story?
Quarter after quarter, year after year, consensus underestimates how much the 5 hyperscalers are going to spend. And you saw that again here in the first quarter earnings season. Right now, after the most recent positive revisions, consensus expects those hyperscalers to spend $700 billion this year and $875 billion next year. So this is a story that continues to evolve, and it's been a key support for the economy and the markets. But I just want to highlight the point that the CapEx that we're seeing right now is not just AI. There's a lot of other positive green shoots that you're seeing that suggests it's a lot broader. So manufacturing PMI has been above 50, which is expansion territory over the last 5 months. And our ISM new orders signal from the dashboard is even more green than the overall survey. So that is a really good development for a broader industrial cycle. Industrial production has moved higher. Core capital goods, orders and shipments have moved higher. That's a good proxy for business investment. So you're seeing, CapEx move higher, and it's, again, not just an AI story. And when you think about CapEx cycles, you have 3 tailwinds going on right now. Strong earnings. Earnings and CapEx cycles are generally positively correlated. You have the tax incentives from the One Big Beautiful Bill that are kicking in this year. And then you're also seeing a manufacturing renaissance with a lot of reshoring that's occurring. So I'm pretty encouraged. I've been waiting for a real CapEx or industrial cycle for years, and it appears we are seeing it, and it's not just an AI story.
Jeff, transitioning a little bit here, we've got some news out of Washington, D.C. President Trump has announced some new developments on the tariff front earlier this week. What has he announced, and does it impact your constructive outlook on the economy?
It does not impact my constructive outlook at all. Tariffs were a headwind in 2025. They are tailwind this year. And even if the effective tariff rate goes back to 11%, it's at 7% today, I'm not concerned because you do have tariff refunds that are going out, and that's going to more than offset the increase of tariffs that you're going to see as those IEEPA tariffs get replaced. Now, what was announced? The first of the 2 Section 301 tariff proposals. This is going to impose a 10 to 12.5% tariff on 60 economies through forced labor investigations that went on. And this is going to cover 60 economies and 99% of US 2025 imports. There's a section investigation that's going on excess capacity, and that's going to be used to increase tariffs on a subset of countries that had higher rates than that 10 to 12.5% baseline. So, think of countries like China or Vietnam, for example. But when you put this together with the refunds that are likely going to be going out over the course of this year, it's going to be on pause probably for about 3 or 4 weeks. That's going to be offsetting, and it's really not going to impact the economy like we saw in 2025.
Let's try to pull this all together. There are a lot of folks who think that we are late cycle. Would you agree with that assessment?
I wouldn't. There's a debate on where we are. I would say we're mid-cycle. You look at different areas of the economy, and they're telling you different things. For example, if you look at non-tech CapEx, consumer spending, housing, employment, all feel very early cycle to me. You look at the earnings growth that we've seen in U.S. equities and the S&P 500. That's early cycle. You only typically see that off of recessionary lows, the strength that we're seeing. You look at something like tech CapEx, much more of a mid-cycle development. So, I would say we're mid-cycle. And if there was a period that this reminds me of, I would say 1996, kind of right in the middle of that 1990s expansion. So we are eventually going to get a slowdown, but I would think it's going to be a mid-cycle slowdown rather than a recession that happens during late cycle environments.
All right, Jeff, I'd like to transition to the capital markets here, moving away from the economy. I'd like to stick with the theme that you've highlighted here today around resilience. The S&P 500 has been quite resilient of late, despite the uncertainty in the Middle East. How does this rally off the late March lows compare to history?
It has been a strong 2-month rally. Off of the lows 2 months later, the S&P 500 has delivered 19.5% price returns. So it's the 8th strongest that we've seen going back to 1950. Now, there's not a reason to be nervous about this strength, although some of these 2-month strong moves have occurred after recessions. A lot of others have actually been firmly rooted within economic expansions like 1997, 1998, 2019, and 2025. And when we focus on those non-recessionary periods, because that's very similar to where we are today, stocks have continued to advance on a forward 3 and 6 month basis after those rallies, and it was a non-recessionary type of environment. The S&P 500 has delivered 5.3% and 8.5% returns, respectively. So an object in motion tends to stay in motion. And when you look at those 4 non-recessionary periods on a forward 3 and 6 month basis, not in any instance did you see a negative return. So I think the markets continue to climb higher like we've seen throughout history.
We all know that earnings have been a key driver of the positive market action we've seen year to date. Can that continue?
It can continue, and it is continuing. When you look at next 12-month earnings expectations for the S&P 500, saw another chunky increase at the end of May. Right now, next 12-month earnings growth rates are above 25%. And the key question, I think, for investors is, are we approaching peak growth? And my answer is no, at least from what I'm seeing in the AI CapEx space and just CapEx trends in general. Those are going to be key drivers of earnings growth because one company's expenses, of course, is another company's revenues. So I think earnings are going to continue to do the heavy lifting. And when you think about earnings, it's not just an AI CapEx story. You have positive operational leverage. What that means is costs are coming down as wage growth moderates and revenues are higher, right? That is a really positive combination for strong earnings delivery. You have AI adoption, kind of this run it lean mentality where companies are doing more with less, employees are becoming more productive. You have improved pricing power. So valuations haven't really been a key driver of returns over the last 6 years. And I think that they won't be a key driver. I think earnings are going to do the heavy lifting just like we're seeing here today. And when you think about higher valuations, just a quick aside here, we've been above a 20 PE over the last 6 years, 2/3 of the time. So we're just in a higher valuation regime, and that shouldn't be a reason to get nervous and not put money to work in equity markets.
So, Jeff, it's great to hear that you're really expecting potential further gains in the United States. But how about abroad, outside of the US? I know recently you were on a panel at an event that was hosted at Harvard, and in that session, you highlighted the opportunity in emerging markets. Why are you still so optimistic on that asset class?
Comes back to earnings. Earnings are what drive markets over the intermediate and long term. And believe it or not, 40% of the MSCI Emerging Market Index is tied to that EM CapEx trade. A good way of looking at this is to look at how much 2026 earnings expectations have changed over the course of this year. So January 1 compared to today, what is the difference in 2026 earnings expectations? Well, on the MSCI Emerging Market Index, earnings expectations have been revised higher by 28% through the end of May. Massive increase. The US has been doing well, but MSCI US has only increased by 7%, Europe and Japan 3% apiece. So this has been a key reason for emerging market strength, and I think that this will continue as that build out moves forward. Furthermore, if you get some sort of resolution in the Middle East, emerging market economies are very heavily exposed. Most of them are energy importers rather than energy exporters. If you do get a resolution in the Middle East, the US dollar will likely weaken. Some of that geopolitical strength that you've seen is going to be reversing. You could see lower bond yields. Valuations aren't demanding. So there's a lot of reasons to be optimistic in that space. And part of them are tied to EM, but there's a lot of other things like a change in developments in the Middle East or valuations re-rating higher, which could make this run continue that we've seen over the last year.
You just touched a little bit on this, but I'll ask you for maybe some further clarification. Are there any particular regions that look attractive to you in the emerging market space?
Yeah, so if you're talking about that kind of EM trade, if you will, Taiwan and South Korea are going to be the areas of opportunities there. It's going to be very volatile. We're clearly seeing that with the sell-off that we had with Broadcom yesterday. But ultimately, you're not going to see a meaningful chip response until 2028. So pricing is going to remain firm, and that should drive the earnings of those two regions. I'm also optimistic on a commodity cycle, metals in particular moving higher. So that should benefit areas like Chile, Brazil, Indonesia. So I do think that there's opportunities within EM, but I ultimately think just given the fact that you have a lot of inefficiencies in the emerging market space, this is going to be an area where active managers can provide some durable alpha compared to some passive benchmarks.
Jeff, it really seems like every time non-US equities have led in recent years, it's been for very short periods of time, and then there's kind of a bit of a reversal. What are the catalysts that are out there for a more durable, long-standing non-US outperformance going forward?
Well, I have a lot of different potential catalysts. First is the weaker dollar. There's a 0.6 correlation between the rolling 5-year performance of the S&P 500 versus ACWI ex-US. So if the dollar is strengthening, that is coincided with US outperformance. If the dollar is weakening, it's coincided with non-US outperformance. And I'm of the opinion over the next 5 or 10 years that the dollar is going to get structurally weaker as a lot of global central banks start to diversify their dollar holdings. The administration wants a weaker dollar. You may see some higher inflation due to debt sustainability. There's a number of reasons why I think the dollar will weaken structurally. Second is if you have a higher inflation or interest rate regime, right? Higher interest rates isn't going to be good for growth equities or defensive equities. It's going to increase the cost of capital, but it does benefit more cyclical areas of the market because when you have higher inflation, you have higher nominal GDP, you have higher revenues, and that really supercharges the earnings potential of cyclical areas like financials, industrials, materials, and energy. And they are much more prevalent overseas. Same thing with a commodity super cycle, and particularly metals. If you look at the AI build out, this desire for renewable energy to diversify away from oil and natural gas, the electrical grid upgrades, again, that's going to be much more prevalent overseas. You have much more of an ability for government spending overseas. The US has deficits of 5-6% of GDP. That's not going to move higher, but a lot of other countries have much more fiscal flexibility. You could have the return of the Chinese consumer. You can also have the democratization of AI. As these models get more efficient and they get broadly deployed, that's going to create a lot of cost savings from less efficient business models. That's the small cap space in the US. That's emerging markets and non-US companies. And then lastly, valuations are pretty compelling. So if you get 2, 3, 4 of these catalysts that are working at the same time, I think that could be a recipe for more sustainable outperformance than what we've seen.
Jeff, let's go to your closing thought for our listeners.
I think the closing thought is that the equity markets have been remarkably resilient over the course of the last 4 months. If we go back to late February, the markets were pricing in 3 rate cuts through the middle part of 2027. After the release that we have with payrolls, the markets are pricing 1.5 rate hikes. So you've seen a shift in Fed funds futures by over 100 basis points. Markets haven't flinched. You've seen the 10-year Treasury rise back up to 4.5%. Markets haven't budged. Energy prices higher. Markets have been resilient. I think the markets are sending us an invaluable signal that we're going to get a large positive productivity shock, and you're going to have really strong earnings growth as we move forward. And that's going to happen not only because of that productivity shock, but deregulation and pro-business policies from the One Big Beautiful Bill. So we continue to be constructive on the markets. If we do see a dip, we're in the buy the dip camp, and we think the markets will melt higher as we move through the back half of the year.
Jeff, thank you for your time and your wonderful commentary here today along the lines of the theme that you've driven out: resiliency, resilient U.S. consumer, corporations, and economy driving opportunity here in the United States. Also, some wonderful perspective on the opportunities outside of the U.S. in the emerging market landscape. To our listeners, thank you for spending your valuable time with us today for the update. If you'd like to hear more Talking Markets with Franklin Templeton, please visit our archive of previous episodes and subscribe on Apple Podcasts, Google Podcasts, Spotify, or just about any other major podcast provider.
This material reflects the analysis and opinions of the speakers as of June 8th, 2026, and may differ from the opinions of portfolio managers, investment teams, or platforms at Franklin Templeton. It is intended to be of general interest only and should not be construed as individual investment advice or a recommendation or solicitation to buy, sell, or hold any security or to adopt any investment strategy. It does not constitute legal or tax advice. The views expressed are those of the speakers, and the comments, opinions, and analyses are rendered as of the date of this podcast and may change without notice. The information provided in this material is not intended as a complete analysis of every material fact regarding any country, region, market, industry, security, or strategy. Statements of fact are from sources considered reliable, but no representation or warranty is made as to their completeness or accuracy. What are the risks? All investments involve risks, including possible loss of principal. The value of investments can go down as well as up, and investors may not get back the full amount invested. Equities securities are subject to price fluctuation and possible loss of principal. Fixed income securities involve interest rate, credit, inflation, and reinvestment risks and possible loss of principal. As interest rates rise, the value of fixed income securities falls. Treasuries, if held to maturity, offer a fixed rate of return and fixed principal value. Their interest payments and principal are guaranteed. Active management does not ensure gains or protect against market declines. There is no assurance that any estimate, forecast, or projection will be realized. Investors cannot invest directly in an index, and unmanaged index returns do not reflect any fees, expenses, or sales charges. Past performance does not guarantee future results. Any companies and/or case studies referenced herein are used solely for illustrative purposes. Any investment may or may not be currently held by any portfolio advised by Franklin Templeton. The information provided is not a recommendation or individual investment advice for any particular security, strategy, or investment product, and is not an indication of the trading intent of any Franklin Templeton managed portfolio. Data from third-party sources may have been used in the preparation of this material, and Franklin Templeton FT has not independently verified, validated, or audited such data. FT accepts no liability whatsoever for any loss arising from use of this information, and reliance upon the comments, opinions, and analyses in the material is at the sole discretion of the user. Products, services, and information may not be available in all jurisdictions and are offered outside the U.S. by other FT affiliates and/or their distributors as local laws and regulation permits. Please consult your own financial professional or Franklin Templeton institutional contact for further information on availability of products and services in your jurisdiction. Issued in the U.S. by Franklin Templeton, 1 Franklin Parkway, San Mateo, California, 94403-1906, 800 dial Ben, 342-5236, franklintempleton.com. Investments are not FDIC insured, may lose value, and are not bank guaranteed. Issued by Franklin Templeton outside of the U.S. Please visit www.franklinresources.com to be directed to your local Franklin Templeton website. Copyright 2026 Franklin Templeton, all rights reserved. Podcast theme music by Adam Vodofsky.